Today, I'm going to be talking about PDT.
The what?
The pattern day trader rule.
Yeah, I knew that.
And everything I would be doing if I was a beginner to get myself out of PDT as quickly as possible. What's going on, guys? It is Dom from Clover Trading. If you haven't already seen, we've been posting weekly videos here on YouTube
Every Monday.
So make sure to go check out that other free content we have. Make sure to like this video, subscribe to the channel so you don't miss out on any future content. Today, I'm going to be talking about PDT. If you don't know what that is,
You're about to laugh. What
the pattern day trader rule states that if you do not have more than $25,000 in your account, you can only place 3 day trades in a 5-day rolling period. So that means for the most part, 1 buy, 1 sell, and that equals 1 day trade. You can only do that 3 times during a business week. There's a lot of mixed opinions on the PDT, if it actually helps early traders, if it hurts them. I'm kind of somewhere in the middle. I think, coming from someone who started with a $2,500 account and blew that up relatively quickly, I do think it can be dangerous for people to start with big sums of money when they don't necessarily have the knowledge and the experience needed to make money consistently in the market.
Cool story, bro.
So the first thing I want to talk about is if it is advantageous or not to have multiple accounts from the beginning. So if you had maybe $15,000, that's what you wanted to start on your journey as a day trader. What I did once I got to $15,000 was split that up into 3 $5,000 accounts. I was only risking $100 or less per trade. So I had plenty of money to trade with when I had a $5,000 account, but by having 3 different 5K accounts, it allowed me to have 9 day trades as opposed to 3. So I didn't need to feel all the emotions and the pressure when you only have 1 day trade left and maybe you have 2 good setups you want to trade. So by splitting up the account, it allowed me to take each trade as it came, have the ability to, when the market sped up, trade 3 or 4 positions at one time, which I wasn't able to do with just 1 account. And it really, in my case, really helped me out. And what I did was just built those accounts until the cumulative value of them became over $25,000. And then I put them all together, put them in 1 account, and was over the PDT and able to start trading freely.
Good stuff, good stuff.
The next thing that I would be doing if I was back under PDT would be really narrowing my focus. And you'll hear a lot of successful traders talk about this, especially the Clovers. We all really started with 1 or 2 patterns that we try to perfect and become a master at. It's very hard, especially in the beginning, to be really good at a plethora of different patterns. You have to start with 1, really master it, grow your account, and then eventually, as your account gets bigger, your knowledge and experience grows, you can add in other patterns that can potentially make you more money or keep you consistent when your main pattern isn't there. So when I say narrow my focus, for me, it means really looking at the best of the best, really liquid charts, really volatile charts, the in-play stocks you'll hear me talk about if you're in the Clover room, where something on the screen right here, like Lunar, this is the first time in a long time that this stock has become in play. It's doing massive volume for the stock. It's doing a big move from $10 to $50 a share. That's really volatile. It's going to attract a lot of short sellers. It's going to attract a lot of FOMO buyers. These are the type of charts I'm looking for. And whether, I talk a lot about the life cycle of a penny stock, whether my main focus pattern I'm looking at is breakouts, first red days, first green days, any of these daily chart patterns I talk about, a lot of these in-play stocks will give you that moment at some time to take advantage of them. Lunar had a really nice breakout, a really nice first red day, a really solid first green day. And from the beginning, I wasn't trading every part of that pattern. I was trading mostly OTCs at the time, and I was trading predominantly OTC breakouts. That's how I built my account. I had to understand that it wasn't fun to ignore all day 1 runners or not be able to short first red days, even though I had a good concept of what I needed to do on those days. Understand that the goal is account growth. And even though that's boring, even though that means I'm going to trade less, it's going to put me in the position over time to allow my system to work and to make me money and grow my account and get me over that PDT so I can become, a real trader who can trade in and out, build into a position, and not be confined to sometimes having to make decisions based on the PDT rule. So charts like Lunar, charts like BBBY that we just saw run recently, stocks that are doing really incredible volume. They're volatile. They're going through a lot of patterns. Stocks like AMBI that we just saw recently, where the stock just kind of comes out of the blue, becomes liquid, becomes volatile, and there are patterns to be played there. And even currently in the market we're seeing right now, there is some OTCs to be playing from, some multi-day breakouts, some first red days, some first green days. I'm just looking for stocks that really do just meet the volume requirement, meet the volatility requirement. They have range. I can learn from their behavior and pick that one moment in the chart pattern that makes sense to me that I can consistently do based off my stats and my performance, and just try to compound that over time, which takes me to my next point, which is risk management and how important this really is at the beginning of anyone's trading career, because it doesn't matter if you start with a $2,500 account or a $50,000 account. If you don't have risk management, it is very difficult for your account to grow. You're going to have such a small margin for error at the beginning that you need to almost be perfect. You need to be robotic. And for me, the main thing that I'd be focusing on in terms of risk management, besides just understanding that I need to cut losses at my risk level every single time, because giving that one trade some wiggle room or adding to a loser, those horrible risk management qualities, you don't have that much wiggle room at the beginning to really afford any disaster. Maybe you only have one try, one bullet, one shot to make this day trading thing work. And if you blow up your $5,000 account because you started bag holding something you added to a loser, or you took a big loss and got, they bought you in, whatever it is, that might be your one stay, your one opportunity. And that I don't think is worth any one trade. So for me, using consistent dollar risk was really important from the beginning. Pick a number that I'm willing to lose, and lose on every single trade that I feel comfortable taking that loss every time. It's big enough so that way I can actually grow my account if the market does heat up or my pattern does start showing up more often. For me, when I had anywhere from a $2,500 to a $10,000 account, I was risking about $100 a trade, $50 to $100 a trade. But once I picked that number, I used it consistently. And I didn't stray away from that. So it allowed me to, if I was willing to risk $100 on this trade, then it was probably a good setup and one I need to take. And it allows my numbers to be very easy to go through my stats, because if my average loser is actually $170 and I'm trying to risk $100 a trade, then I have a risk management problem. Maybe I'm oversizing, or I'm not taking into account potential slippage, or maybe I'm giving positions a little too long before I cut. By having that number that you risk on every single trade, it allows your stats to be really easy to follow so you can learn from them. It also allows me to, understand my risk reward a little better. If I know I'm consistently risking $100 and my average winner is only 125, I'm not doing a very good job either win percentage wise or risk reward wise to be having a system that's going to grow my account over time. In one of my YouTube videos, I talked about drawdown periods, and going back to a small account like this, the discipline and the patience it takes to grow a small account over PDT is the same type of thing I'm going back to with my blueprint. I'm making sure my risk management is under control, that I have a consistent risk, that I'm focusing on liquid volatile charts that are in play and are showing me patterns that are involved in the life cycle of a penny stock. And by doing all these things and by really narrowing my focus and being disciplined and patient for those setups to come along, I allow my system and my process to work over time. It's really going to be market dependent when you get started, if that pattern that you chose, or those one or two patterns that you chose, are really working and are there right now, how long it's going to take to get over PDT. But from personal experience, all it took was kind of small growth. Once I stopped the bleeding and I started narrowing my focus, I started losing less because I wasn't taking so many lower quality trades or taking setups that weren't in my arsenal, or the ones that I really did have good numbers on. And then I had to stop the bleeding. Then I had to start growing. Really small green months, really small green weeks. But once I cut out all the other noise, I was able to start moving in the positive direction. And then I was met with preparation meets opportunity equals luck, a hotter market. I was only trading OTC breakouts. All of a sudden, the marijuana sector started to go off, and then the Bitcoin. And all of a sudden, I was able to grow my account really quickly because I was really patient, really disciplined. I was really into my blueprint. I was into my process, and the process started to work for me exponentially. And then on a $10,000 or $15,000 account, I made $4,000 in a month, and then $9,000 in a month, and then $20,000. All of a sudden, I blew right past PDT because I was trading in such a flow state and had so much momentum going. And then the market just kind of gave me all these extra high quality and high quantity amount of trades, and everything really worked for me. So that is how I would tackle PDT if I had to go back and do it again with the knowledge that I know now. If I'd done these things from the beginning, I do believe my learning curve and my ability to get out of PDT quicker would have maybe been cut in half or even just by a couple months. But really it is just getting back to the blueprint, understanding that every trade means so much when the margin for error is that small at the beginning, and doing everything I can to be as consistent as possible so that way I can get out of PD as quickly as possible and survive till the next hot market. So there you have it. That's how to get out of PDT as quickly as possible. I'm Dom with Clover Trading, and I'll see you in the next one.